The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome to Volatility Views, your weekly source for volatility news, information, and analysis. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network, and I am joined, as always, by the man, the myth, the legend, none other than Don Schlesinger from Volex. Don, welcome back to the show.
Happy to be here, Mark. Looking forward to a little bit of a difference today. We don't have a guest. We are going to answer several questions that have piled up, and that's always very enjoyable for me.
Yes, it's nice. Not that I don't like the guests. I love having the guests on as well, but it's always fun to have a chance to sit back and crack open the old mailbag every now and then, too. So that's exactly what we're going to do this week. But first, we're going to dive right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we discuss all the volatility action we saw unfold over the past week. And Don, since we've been talking about NASDAQ quite a bit recently, maybe we'll start in the NASDAQ realm today. So what are we seeing in the land of Apple Plus, a.k.a. NASDAQ vol these days?
Starting to see just a little bit of life and a little bit of a pickup, both in the short-term and longer-term volatility. We've been mentioning now for several weeks the very low levels, and while nobody wanted to go out on a limb and predict that anything dramatic would happen, it seemed prudent to think that volatility would ratchet up a little bit. And so 1 month realized volatility little bit ago was in the 12 and 13 handle, but we see it now at 15 and 3/4. And the 3 month or 63 trading day realized volatility is now sitting at 1277 when it was down in the 11 handle just a week or two ago. So again, nothing dramatic, but we are starting to see that little bit of a rise in the realized volatility that we had been anticipating.
Yes, a lot of interesting developments over there in NASDAQ land, and of course, a lot of that being driven, of course, by that big, well-known fruit company that seems to be just moving the NASDAQ on a whim today. Of course, we are actually recording at our normal time again today. That's a nice change for us. We've been all over the map, it seems, lately with this program. So right now at noon Central here in good old Chicago, the major indices are mostly up about half a percentage point or so, and the VIX cash is selling off to the downside, down about 1 1/4 handles to almost 17 even. That brings us back to the discussion we had a few weeks ago where we were pontificating on this show whether or not VIX had finally settled into a range in, the 14 to 17, 18 range, perhaps for the next few months. And then sure enough, as soon as we said that, of course, it broke out immediately to the upside. Well, it is now settling back again into that range again. So it will be interesting to watch this going forward and see exactly what type of developments we have. Over the course of this week, it was a bit of a whipsaw week from a VIX perspective as we kind of gapped all over the map. We also saw that continuing process of that term structure continuing to ease a bit in the futures. It is nowhere near as pronounced as it was just a few months ago. Of course, we'll be getting into the term structure a little bit more in our mailbag segment.
And I think that Mark Sebastian will be joining us later, but that to his credit, when VIX did sort of momentarily spike up back into the 20 level or so, and Mark discussed whether that was likely to hold, I believe his opinion was that it probably wouldn't, and that we'd be looking at 17, 18 range very shortly thereafter, and that in fact has come to pass.
Yeah, it's a weird environment right now where it seems like you have to fade any major move just in the opposite direction. And if you are leaning heavily short or leaning heavily long in something like VIX, maybe you do want to have a kicker on the other end if you're short a lot of, or if you're long a lot of puts or long downside premium in VIX, perhaps an upside vertical call kicker or something like that, just to protect yourself against the odd aberrant move in the other direction. Because as we said on some of our other shows this week, that it's just an interesting time right now where we're kind of in a bit of flux, a bit of wait and see as we're waiting for the next shoe to drop, whether it's in Europe or a number of other places. Of course, the big fruit company has earnings next week, and that'll be interesting to see what that does to the market, because where Apple goes, the market and volatility seem to follow. So a lot of...
And it's true, Mark, that right now, as you say, we're kind of like in flux. There's just really no great trend here and not a great deal happening. There's noise on a daily basis, to be sure. I'm not saying that the markets aren't moving, but they're really not moving in any trending or meaningful direction. And when you have that, you would expect that the same would be true for volatility. You'll get those little spikes up, whether it's VIX and implied or actual market or realized volatility, and you'll level off again for a while. So difficult to make any longer term predictions or to say that any of these day-to-day movements are anything but somewhat of a random component and just a little bit of noise here or there without anything terribly meaningful going on.
That's true. We didn't have anything like a debt downgrade or a meaningful meltdown in Europe or anything along those lines that would really indicate a direction in which we're heading for the near term. It's kind of, you're right, it's just been vacillation. It's been vol, a lot of noise without much significance lying underneath. But fun from a volatility perspective, that's for sure.
That's for sure.
All right, that is going to do it then for our volatility review. And now we're going to dive into the much delayed, but Don and I are both looking forward to opening it yet again, the volatility mailbag.
Listener mail. Listeners write in.
Mail's in.
Mailbox.
All right, and welcome to the old listener mail segment. This is, of course, a portion of the show where Don and I take a back seat and let you guys steer the ship. And the first question comes in via email from Tim Sifron out in Lansing, Michigan. He writes, I love your show and the great guests you guys managed to wrangle. Well, thank you for that, Tim. It has been quite the effort, mostly on Don and the guys over at Volex's part, really wrangling these guests. I can't take any credit for this great string of guests that they've been able to wrangle for the show. That's probably a good word for it, wrangling, because that's exactly what it is. It's like herding cats sometimes. He goes on to say, but I was a little out of my depth with last week's guest. It's been a while since I took a stats course, so your discussion of jump frameworks and stochastic volatility models for pricing OTC variance swaps was a tad out of my league. Can you give a quick plain English summary of the takeaways from that discussion for those of us who may have had trouble following along? Thanks, and looking forward to the NASDAQ contracts. And Tim here is, of course, referring to our show last week where we had several researchers on discussing their thesis on pricing OTC variance and vol swaps and some of the most effective ways to do that. And they were actually talking about a couple of different things at once. But the main focus of their thesis was trying to find the most effective pricing model for these variance swaps. And the struggle with these products is that you have to find the quote unquote the fair strike price that enables you to minimize the outlay at the start of the contract. The customers don't want to come in and have a significant outlay when they start the contract. They want to keep that as close to zero as possible. So you need to find a strike price for obviously a volatility strike price, or a variance strike price in this case, that allows that, and is also at the same time an accurate gauge of what the volatility may be over the course of that contract. So that's a difficult challenge, and people have used a variety of models to do that. And what these guys did last week was really sat down and analyzed the various models that have been used, everything from the traditional old school Black-Scholes, which has been an option staple for a long time, to a number of more complex models, including models like you asked with that jump framework. And what they're talking about there really is just trying to use a model that more accurately can handle data that doesn't move in a smooth, continuous line. It actually jumps around somewhat erratically, which is more indicative of what we see in the financial markets. Underlying prices don't tend to just move in a straight line. They jump all over the place. They gap as new news comes in and as developments occur in the marketplace. So they wanted to look at models that may more accurately reflect that. So that's what they were talking about when they're looking at those jump models and applying those jump distributions across a variety of different models. And what they determined, they actually had several takeaways, but they determined that the more complex models seem to work the best, as you would think, but also that the efficacy of those different models varied across the term structure, or I should say the duration of the contract. So some models worked better on the very, very short 1-month variance swaps. Some worked better on the 6-month swaps. Or their takeaway was you really want to find the Goldilocks type model that is not simple or too simple that would miss important developments or dynamics from the underlying, but not too complex that you would spend a lot of time trying to overfit the model. And everyone who spent a lot of time looking at vol curves and vol skew knows that overfitting is definitely a common problem we see here in the land of volatility. So those are some of the takeaways. Don, what else what other takeaways did you get from our discussion last week?
Yeah, I mean, Bob and I have been doing a great deal of studying recently about vol swap and variance swap methodologies for pricing as we look forward to listing our NASDAQ vol contract futures and kind of speculating ahead of time on what kind of pricings we'll see. So we're kind of knee deep in the academic literature and some of these formulas for pricing. But the takeaway really is that there is no perfect methodology, and even if someone came up with the absolutely perfect prediction of what future variance or future realized volatility would be, we all sort of know that that's not the price you'd be paying for the variance swap or the vol swap anyway, because these are, in a certain respect, sort of insurance policies, hedging vehicles for future volatility. And as such, there is a risk premium that's built in, just as there is with options, as the sellers take the open-ended risk of some very large movement, whereas the buyers don't incur that same risk. So it's important to understand the difference between trying to make Garch-like predictions of actual realized future volatility and not confusing that with what a fair price or what a market price of a variance swap or a volatility swap or a vol contract futures might be, because they're not the same. And so these two researchers kind of really set out to see what the best fit would be for closeness to future realized volatility, but they didn't make any claims as to whether or not these models would actually price the merchandise in the marketplace. They weren't traders, and they weren't attempting that exercise. So kind of important to make that distinction. The only other comment that I'll make, since the question specifically talked about jump framework and stochastic volatility, you summarized that very well, Mark. I would just simply add that one of the criticisms, if you will, of the Black-Scholes options pricing model is that it makes two assumptions that, as you mentioned, we all sort of know really don't hold in the marketplace. It makes an assumption that we have continuous smooth trading without any kind of violent jumps or surprises. And we all know that that's not the reality of markets and how they trade. And it also asks you for an input of your estimate of what volatility will be during the period that you're holding your option, during the maturity of the option. And once you furnish that number, the classical Black-Scholes model just holds that value. It just simply enters it as one single input. But recent studies with what is called stochastic volatility, or accepting the fact that volatility itself moves around during the holding period and has a certain volatility or randomness of its own, have led to pricing models where you are able to vary volatility over the tenor of the options and hopefully produce a slightly more accurate pricing model. So they were simply taking those two rather well-established principles that apply to options modeling and now applying those same principles to trying to come up with better models for swap and actual volatility derivatives pricing.
And Don, of course, you did attempt to hold their feet to the fire from a practical trader's perspective and try to get them to dive in on whether their model could be used to actually trade and make those predictions. And they demurred, as a good academic should do. But still, it was you did your duty for God and country in that sense there, Don. And it is
occasionally we run into the very rare academic, and it is rare, who has some sort of trading experience or actual real world experience. So it always pays to ask the question, but as you mentioned, you rarely do get the answer simply because it isn't their realm, it isn't their sphere of knowledge, and we surely don't hold that against them, but every once in a while we get pleasantly surprised.
And it's worth noting that this area of study is definitely worth pursuing given the enormous notional size of these contracts in variance land. And if you can find a process or a model that can more accurately predict that fair strike price, you can save a significant amount of money over the course of that contract. So that is definitely, if you're active in the OTC variance and vol swap land, that is something that I think that would definitely be of interest to you and was a fun discussion last week. Next up on the old mailbag, we have a kind of a fun question from Joe X4 here on Twitter. He writes, Mark and Don, who is your favorite Vol Views guest so far? Loved the show. This is a difficult one, Don. It's kind of like choosing children, but there's been such a string of interesting guests here on the show. If you look at our back over the course of our episodes, everyone seemed to really like the Ewan Sinclair episode we did last year. So I suppose I can't second guess our listeners, but on the same, for my money, I enjoyed the discussion we had with Nikunj Kapadia there from the University of Massachusetts. Maybe not so much for the discussion itself, but for what it engendered in the debate and the discussion that it engendered afterward. If you remember that episode, listeners, that was the episode where we discussed the tail risk in the SPX puts and whether that was overpriced or underpriced. And it was a fascinating discussion, and it led to an even more fascinating debate over the next few episodes as we discussed the various intricacies, the various intricacies of pricing tail risk premium in those puts. And so that was, I think, for me, one of the more interesting conversations we had, and that, of course, segues into and carries over to the guest as well. What was your favorite there, Don?
Well, in preparation to answer the question, I wasn't going to take the fifth, but I certainly wanted to say that I don't want to say one single name. We've had too many outstanding guests to limit it to one. So I made a very short list, and that's not to say that it's all inclusive, but we tend to kind of identify with people who either perhaps think the same way we do or have similar backgrounds, both as a trader and somewhat into the mathematics of things. So I've had several that I enjoyed very much. And Ewan Sinclair, who has both practical trading experience, has written a couple of books, and also is extremely strong on all the theory and the math, was surely one of the highlights, as evidenced by the number of downloads. And I'm very happy to announce to everyone that Ewan is coming back on the show next week. So he's our first repeat guest, and rightly so. So we're looking forward to that. Others who come to mind with similar types of background were Bill Luby, who writes his VIX and More column, and surely has both the theoretical underpinnings and the trading knowledge. So I very much enjoyed his appearance. Simon Acom, who formerly was at Morgan Stanley, my old stomping grounds, and who gives classes and seminars on volatility and volatility studies, I thought was very good. And of course, a couple of academics, but those associated with NYU and the volatility lab there, both Steve Figluski, and you can't not include a Nobel Prize winner as one of your favorite guests. So our show with Professor Robert Engel was outstanding. And I might throw in that I very much enjoyed our time with David Palmer from Hudson Bay Capital. I thought he was very eloquent, and we had several discussions that I enjoyed. So I'm happy to point out to listeners that this is our 52nd show, if you count our previews, and we have had guests on 24 of those shows, and we actually have guests scheduled for the next 3 weeks. So that'll bring it up to kind of like 27 out of 55, or just about half of all of the shows we've done have had a special guest. So we're really very happy with that, and I think the listeners are enjoying as well.
That was quite the guest sampler you rattled off there, Don. I suppose you're right. You can't pick just one, though. It is difficult, and it has been such an impressive run from a guest perspective. And moving on here in the old mailbag. Next up, we have an email from Ashton Valance, or perhaps if he does the Italian pronunciation, Valance, in Hoboken, New Jersey. And he writes, Mark L., Mark S., and Don, now that you are discussing NASDAQ vol on the show, do you find that it performs dramatically differently from S&P vol? If so, how much of that difference do you attribute to the relative dearth of NASDAQ vol products versus the explosion of S&P volatility ETPs? Mark L. has said many times on the show that the VIX has many masters these days, not just SPX front-month volatility. On the flip side, it seems that NASDAQ vol currently has only one master. Are these various masters pulling the VIX in different directions from NASDAQ vol? Also, would the lack of NASDAQ vol ETPs, quote, polluting the waters, make NASDAQ implied vol a more pure product from a volatility perspective? And this is something, obviously, Don, that we've touched on in the show several times in the past, the growing universe of ETPs around VIX and how that may be impacting the developments we're seeing in VIX, both VIX volatility and just the VIX itself, and how that could compare to some other products. I mean, this is an interesting question he asked, how that compares and contrasts to NASDAQ vol. So one of the first things I did after I read this question was I went back through my database and through my systems here and just looked at the various products that are available from a NASDAQ vol perspective. And it's a very, very short list. It's, of course, there's VIXN, the VXN, but that isn't really a tradable product. It's really just one of those theoretical, not theoretical, but abstract numbers that the SIBO calculates and throws out every day. It's interesting from a theoretical perspective, but it has no impact on the actual vol of NASDAQ in any way, shape, or form. And then you have a variety of of products in the OTC world, which are trading off NASDAQ vol and variance swaps. We don't have that much insight into those numbers and those products here. And then in the listed world, there really isn't that much else in the way of ETPs that are trading in and around NASDAQ vol. I mean, Don, you guys obviously did your homework before launching your NASDAQ contracts. What else is out there from a NASDAQ vol perspective that someone can even choose from?
Well, there really isn't, and there was an attempt earlier on to do a VIX futures, and it was sort of mired in difficulties and was not successful at the time. There were several reasons for that I won't get into now, but surely as we prepare to launch NASDAQ 100 vol contract futures on realized volatility, and then hopefully shortly thereafter both ETPs and options on those vol contract futures, we hope to kind of firmly establish these types of trading vehicles for NASDAQ to trade hand in hand with the S&P products, and also give an alternative for yet another equity index on which to trade volatility. Insofar as the actual comparison of the volatilities, I found something rather interesting, and at the same time, it allows me to point out a lovely tool for our listeners. If you go to our website, volex.us, on the pull-down menu for data, there is about halfway down Volex indices. When you go to that page, you see a lot of historical data and forward-looking predictions for a variety of underlying indices in various different aspects of the marketplace. And when you go to the NASDAQ and you kind of click on the charts, you get these volatility charts of the Volex indices. And one of the new features that our webmaster, Norm Wattenberger, implemented some time ago was under chart type at the top, you have the choice in the pull-down menu for multi-asset comparisons. And so it starts out with the NASDAQ, but then you get a drop-down menu of all the other assets that are cataloged on that data page. And so I chose SPX. And when you choose SPX, you now compare over any time frame that you like NASDAQ realized volatility, either 1 month, 3 month, or 12 month, to whatever your selection is. So NASDAQ S&P volatility, and at the bottom of the chart, you've got different time frames. How far back do you want to go looking at this comparison of the two volatilities? And it's as short as 10 days, and then it goes through 1 month, 3 month, a year, 2 years, 5 years, 10 years, and then maximum. Maximum is as much data as we have in our database. So I chose maximum, and it went all the way back to 1989. So we've got 23 years worth of data here. And I found something very interesting. We talked about the predictions of VLab for future volatility, and how, the Garch predictions go back some time historically, and how the predictions for future NASDAQ volatility are considerably higher right now today than they are for S&P. And yet the current volatilities are very similar. So I sort of wondered, why that might be. And when you look historically at this comparison, what you see is extremely interesting, and that is for the longest time, and we're talking about all the way from the beginning at 89 until 2008, so for 20 years or so, the NASDAQ volatility was considerably higher than the S&P. It was clearly above, as you look at the graph, with great separation between the two lines or charts for 20 years. And then something very interesting happened. I don't know, Mark, if you have a suggestion for an answer, or if it's just, some sort of aberration. But right about the time when the crunch came in 2008 and the year-end activities there, all of a sudden, these two lines started to converge. And for the last 4 years or so, looking at the NASDAQ volatility and looking at the S&P, you would almost think that you were looking at the same line. There's very little separation, and the two look very similar, just as today, NASDAQ realized volatility is very close to S&P realized volatility. So I don't know if there was some sort of fundamental shift that took place 4 years ago, or whether we're simply in a period where coincidentally and atypically NASDAQ and S&P volatility are much closer together than they have been historically, but I found that rather interesting.
That is a fascinating development, and you're right. It does make you sit back and stroke your beard, in my case, and say, why would that be? There are a couple of possible scenarios on why that might be that just spring to mind as we're talking here. Of course, many people became much more cognizant of volatility during that 08-09 meltdown period, and particularly on the institutional side, and they began trading it more actively, hedging it more actively, and then, of course, perhaps looking for some OTC products, perhaps on the NASDAQ side, to correlate their trading between the S&P and NASDAQ. That time period also correlates very well with the rise in terms of popular perception of the VIX contracts and the tradable contracts in VIX. And 08-09 is really when the public really started to catch on en masse to the VIX product line and become much more cognizant of volatility. So I think that was generally, I suppose you can call that a volatility awakening across the board that period, and perhaps that awakening of interest and knowledge of S&P volatility somehow correlated to NASDAQ. How that happened, I don't know, because you're right, as we discussed, there aren't many products in which to do that. You really have to do some OTC stuff or structure some of your own products using the listed options on the NASDAQ products, but that's a difficult road to hoe. So how they've stayed in that close of a lockstep, that's I think an interesting question to ponder. Speaking of questions, getting back to what Ashton was asking here, he mentions that I say that the VIX has many masters these days, not just S&P vol. I suppose it's worth clarifying a little bit what I'm talking about there. When you're looking at this massive universe of ETPs that has sprung up around the VIX, that tends to have those products tend to have certain impacts on the VIX product itself. Number one, it tends to increase the vol of VIX. So the VIX's vol of vol has dramatically increased over the past few years as more of these products have sprung into being. It's also exaggerated some of the movements we've seen in the VIX cash as a result of these other products having additional effects on an additional amplification, if you will, on the actual movement in the VIX cash. And thirdly, it's had a dramatic impact on the term structure of the VIX futures. And we'll get into that in a little more with a question about the VIX term structure. But those three things have been very dramatic and very easily traced back to the universe of ETPs around the VIX. And obviously, we haven't seen that same impact on NASDAQ because most of those products don't exist. There is no string of NASDAQ vol futures to see the term structure of. There are at least listed NASDAQ vol futures. There aren't a slew of NASDAQ vol ETPs to look at and to also feed back upon NASDAQ realized vol and increase the vol of vol and things like that. So I suppose using the terminology of your question, pure vol, it's a bit of a subjective term, obviously, but I suppose you could make an argument for that right now, because NASDAQ is still relatively unsullied from a pure ETP perspective, that what we are seeing from a NASDAQ realized vol does more accurately reflect what is going on in the actual NASDAQ index and actual NASDAQ volatility, and it is not being exaggerated or distorted by a slew of outside products. Don, would you agree with that?
Yes, I think you're probably right, and I think that it's really dramatic to see the difference between these two. So actually, I went to those same graphs that we were talking about, and I looked at a 12-month realized volatility, again using the maximum data all the way back to 1989. This is really striking. I'd almost invite listeners, if you've got any theories to add to our speculation, I'd be interested, because starting in 1990 and going right up to 2008, as I mentioned before, the separation between NASDAQ and S&P volatility is so dramatic that you would be sure that you were not looking at anything that even remotely resembled the S&P, especially during the famous bubble technology, 2000, 2001. We had year-long, which is a smoother type of average, S&P volatility in the low 20s, and NASDAQ was 62 for a while, worked its way down, but in the entire period from 1990 to 2008, year-long, one-year volatility of NASDAQ was dramatically higher than the S&P. Anybody can just take a look at the graph. And then suddenly, as if to snap your fingers, in 2008, the two lines absolutely coincide, even for the 1 year volatility of the two indices. You practically can't see the S&P line because the NASDAQ is right over it, and it looks like they are twins. Really a very interesting development.
That is very bizarre. And listeners, we are also joined via phone now by one Mark Sebastian from OptionPit.com. And Mr. Sebastian, since you are also addressed in this question, I'll give you a chance to weigh in on this NASDAQ versus VIX, and which is the purer product.
Yeah, well, I think that the NASDAQ versus VIX. Well, the interesting thing is, let's talk about what makes up these two indexes and what the fundamental change is that's happened over the last couple of years that's kind of created what we're talking about. Now, I'm going to just kind of list off the top five, let's just do the top 10 holdings of the SPX, okay? Number one holding is ExxonMobil Corp. Number two, Apple. Number three, Microsoft. Number four is Procter & Gamble. Number five, J&J, IBM, General Electric, JP Morgan, Bank of America, and AT&T. All right. Now, I don't have the top 10 of NASDAQ right now, but I can tell you that the top 10 of NASDAQ are going to go Apple, Microsoft, and then, Cisco, and then Google, and then Intel. And all the top holdings of the NASDAQ are actually in the top holdings of the S&P 500. Stands one fundamental difference, where some of the major holdings in the NASDAQ 100 are things like Amgen and some of the bigger biotech firms. You replace those with some of the bigger financial corps. If we look over the five, and for the up until 2007. If you ask somebody what was the more volatile stock, Bank of America or biotech, your answer would have been what? Obviously the biotechs. And what's happened is that fundamental shift in the financial stocks, and that the NASDAQ 100, it consists of primarily now mature biotech stocks, which was a fundamental change of the NASDAQ 100 back in 2007, I believe. Up until then, the NASDAQ 100 was almost all technology. They didn't have your Amgens, your Gilead Sciences, your Biogens, some of the Spigen, Iodec, pharmaceuticals, some of these Celgene, some of these big, what are essentially pharmaceutical companies. Amgen they call a biotech, but I mean at this point, Amgen is. You look at the structure of Amgen and you look at the structure of Merck. What's the difference? Almost nothing. And so you've had this fundamental shift where NASDAQ has actually moved to less risky assets, and the assets that were traditionally considered to be safe holdings, such as your Bank of Americas and your AT&Ts and Wells Fargos, have been, for the most part, not nearly as safe. And then on top of that, adding kind of the maturing of the tech companies. Microsoft's boring now, Intel boring, Cisco boring, Apple not boring. But
Microsoft's boring, but it just beat its front month straddle for the first time in a long time that I could think of from an earnings perspective. So from an options perspective, that's exciting to me.
Well, no, I realize that, but that's on a relative case. Meanwhile, you've got, if you look at the top holdings, J&J, P&G, General Electric, they all moved more than the option prices. Even AT&T, SBC Corp is kind of crazy. And so what you've got going on now is that there's been a fundamental shift in where risk is of the two indexes, and it's caused the two to converge. So, I mean, that's kind of what I would say is what's happened. I don't know if that's exactly what you said, but
we did, Mark, but it's a very good analysis, and I think the point is well taken that the wild ride of technology from the early 2000s, as you said, some of these companies have become relatively a little bit more stable and a little bit more boring, whereas the big banks that never caused a great deal of concern at that point in time surely have changed ever since '08. And so what was a divergence now has brought the volatility of one somewhat lower and the volatility of the other somewhat higher. And now they've been meeting in the middle for a couple of years. So I think your analysis is quite accurate, and thank you for that.
Oh, thank you. That's great. That is, it doesn't get much better than that, folks. I feel, if you could see me, I'm beaming right now from Don's compliment.
Of course, that time period you mentioned, Don, as Mark just suggested, doesn't just correlate to the rise of VIX in popular perception, but it also correlates in many ways to the rise of Apple to prominence and in popular perception, and becoming the major driver of both of those indices. And perhaps that also plays a role in the increasing correlation we're seeing between NASDAQ vol and S&P vol going forward, is that the 800-pound gorilla in both of those is the same.
Yeah, I don't have that statistic, but it surely would be one that, looking at these graphs, I think would be borne out, and that is the correlation. Actually, the price correlation between NASDAQ and S&P, I would speculate is higher now than it was, 10, 15, 20 years ago.
All right, jumping ahead here in the old mailbag. Our next question comes from our forums from a user by the handle of Captain Options, and I do love that handle. I may have to
I do like that.
I have to take that for my own purposes. That's a good one. And he writes about VIX term structure. What causes it? And he writes, Mark L., Don, and company. And I'm sorry, Mark S., you are listed as company in this one. Oh, my
gosh.
You were listed in the first one, but you weren't on.
For him to imply that you are the greater VIX domain than me is insulting on every level. I'm going to kill that guy.
Well, I shall refer to you as...
sitting this one out in protest.
I shall refer to you as company from now on. But
I'm like the band.
Yes, indeed. Captain Options writes, the VolView show has discussed the term structure of VIX futures many times in the past. Most recently, the emphasis has been on the incredibly steep slope of that term structure. You guys have touched on this a bit in the past, but I wonder if you could voice your opinions on what you think is actually causing such a steep slope in that product. As my handle suggests, I'm more of an options guy than a futures guy, so I'm not particularly familiar with futures term structures and how they should work. I hope my question isn't too remedial for this esteemed panel. And Don, may I just say, sold to you. Wow, that felt great. So, Don.
I told you, Don, you've got a catchphrase now. It's time for Mark. I think it's officially time for us to market "Sold to You" T-shirts.
That might have to come in the Options Insider store for "Sold to You" T-shirts.
I do own the domain TraderTees.com.
Do you really?
Yeah.
Somehow it doesn't surprise me.
We can put "Sold to You" as I may just do that. I'm gonna have my wife design a "Sold to You" T-shirt, guys.
You got to have Don's little silhouette in the background or something like that. That'll be fantastic.
We want to sell T-shirts, Mark.
That's why I said silhouette, not close-up headshot. Just an outline.
I'll jump in here briefly, and then I'll let you guys kick it around a little bit more. Of course, this contango and this steepness of the outer months becoming progressively more expensive than the near term has actually abated and flattened quite a bit in recent weeks and months. But let's go back to the basic concept of why you can see something like that to begin with. And I did touch upon it before. I have my personal opinion on this and happy to hear yours. And that is that anytime you have a nearer term instrument and a farther term instrument, it's quite obvious that the farther term instrument is reflecting opinions, predictions, and ideas of what is coming down the road farther out than the present. That's obvious. And so you can have an environment in the present that would be unusual and that might foster a more severe type of prediction for the future. One such environment might be extremely low volatility, which compared to historical norms is quite a bit below the average. It doesn't take a genius to say if normal volatility is 16 or 18 or 20, and you're in an environment today of 10, 11, or 12, well, then you're going to predict that volatility is going to revert to the mean and is going to go higher further down the road. There are a few people who would look at volatility for the S&P, actual realized volatility in the single digits, 7, 8, 9%, and would predict that a year from today, you're still going to be seeing those levels. So one of the reasons for that kind of steepness or contango is when the present environment is somewhat aberrational and not in line with normal. Now, if you actually combine that with another aspect that could cause that steepness, then you just exacerbate the steepness. And one of the things that was going on for some time was a sort of a complacency and a sort of a prediction that, things maybe are too good and that down the road we can expect the market to sell off, and that we're afraid that, the road ahead, things are not settled in Europe, things are not settled in Greece, there's more turbulence coming. So if someone had that view, he would probably say that the markets selling off have that inverse correlation with volatility, and if it's true that market prices are going to drop, implied volatilities are almost surely going to go higher during that period. So now you're just piling one thing on top of the other. You're in a low volatility environment. You would predict higher volatility anyway down the road. Now you add to that a forecast for possible sell-off in market prices, which would almost certainly be accompanied by increase in implied volatilities. And then you just pile one on top of the other and make the curve even steeper still. I think that's what we saw during that period when we had such very steep contango.
And Don, you're right. We did touch on this last episode, so we'll be brief. And of course, I did touch on this in one of the first questions we had here on the mailbag today. But there was it has been quite a bit of interesting discussion of late, as we said earlier, about these ETPs around the VIX and how some of them are starting to perhaps exacerbate that term structure in the VIX futures. And particularly, a lot of these heavily levered ETPs on VIX are by definition short a lot of Vega, so they come in and are heavy buyers of long-term Vega to offset that. In addition, you have a lot of annuities and some other products that are heavy buyers of this long-term these long-term products out here in the VIX future. So they tend to compound exactly what you're talking about, which is that natural tendency towards contango. Then on top of that, we have these newcomers and additions who are exacerbating in that. And that seems to be the consensus right now on why things got so steep recently. And of course, those players haven't gone away, and the term structure has a lesson. So that is the counterpoint to that argument that
right. Well, you're generally going to see the term structure tighten up as VIX heads toward its mean. What happens is that, I think Don put it well. One of the important things to understand is that, unlike S&P 500 futures and some of the other things, is that the VIX futures and VIX options are European exercise. And that is a very, very, very important thing, which means that any type of small pop or small major drop, because of the European nature of the index, is actually going to get absorbed because people just assume that it's going to head back toward its mean. So when VIX gets really, really, really sold, as Don says, the basic concept is people are more afraid of what's going to happen in the future than they are the immediate, is kind of the way I put it. and there's a constant assumption of mean reversion, as Don said. And you combine those two, and it creates this term structure. Now, one of the things that's kind of interesting about term structure is that any of that long-term stuff, there were periods of time where we saw the long dated stuff trading at 100% premium to the cash. I don't know how you can justify that. Even SPX does trade, SPX vols trade at a contango. That's something to be aware of, is that in the end, VIX futures are still based on S&P 500 volatility. And S&P 500 volatility trades on that type of edge. Why? Well, you're selling the further out in time you go, the longer the insurance policy you're selling, right? Don, I think your protege, Alex Jacobson, who by the way, I don't know if you know this.
He's not going to be happy to hear that.
Alex Jacobson has where some people have like a little Buddha in the corner that they meditate to. Alex Jacobson has a little Don Schlesinger in the corner that he meditates to. And but he actually, he talks about how options are kind of the cost of insurance, and VIX is a measure of cost of insurance. Well, the longer the insurance policy you're selling, the more kind of protection you need against kind of intermediate movement. And so S&P 500 options naturally have some long-term volatility contango. The curve itself has contango, and VIX futures and VIX options are just partially a reflection of that as well. And that's an important thing. In the end, all of these things are derived off of the S&P 500 index. VIX cash is derived off the index. And so some of the long-term December stuff is based off of that S&P 500. So, here's an example, all right? Right now, the November VIX future is priced at 26.5, all right, which is expensive. Well, let's do December because the S&Ps don't have a November contract. Right now, the December contract is priced at $26 even. The aggregate S&P 500 volatility that expires in December 2012, which is about that same contract, is right around a little over 24%. All right. So if you think about that, option vols trade at a 2 to 4% premium to it typically trade at a 2 to 4% premium, right, Don?
Talking in terms of implied volatility.
Implied to realize is what you typically
actually goes on to become. Yeah, historically the average is like in the upper threes, very close to 4.
All right. So which is 4%. Let's just say it's a 4% premium. That would put S&P 500 volatility right around 20%. That sounds pretty logical for S&P. It's a little high, but the market's been pretty high over the last thing. Well, then, if you consider that VIX is an option premium, is a premium on premium, then it might make sense that a VIX future would trade at a 2 to 3% premium to S&P 500. So, if you consider what the VIX represents and what the VIX futures represent, it makes sense that based on the S&P 500 curve, that the VIX would have that kind of contango. So, that's essentially what I think everything adds up to.
All right, thank you for that, Mr. S. And now we're going to close up the old mailbag for this week and dive right into the crystal ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball. This is, of course, the portion of the show where we peer into the murky volatility ether and attempt to determine what's going to happen in the week ahead. And we'll start with you, Mr. Schlesinger. What are you looking at in the land of NASDAQ vol?
Well, we started to talk about the concept that after such a long period of low volatility, we're starting to see the semblance of a little bit of life and a little bit of pickup. And yes, it could be a head fake, and yes, we could stay right in this range and even drop back again, as we saw with VIX recently. But you don't hear me say it too often. But at this point, and with NASDAQ volatility in the short term between 15 3/4 for 1 month and all the way down to 12 3/4 for 3 months, this is still historically at very, very low levels, whether you use vol cones or any kind of mean value. So if I had to look out in the near term, but at least not holding it to a single week, but rather more to, an upcoming month or 3-month period or so, if I had to make a choice between actual volatility, I'd say higher rather than lower.
And
what? Did you just say buy them?
No, I didn't say buy them.
It sounded like buy them.
I said I thought volatility might go higher. That doesn't mean it'll go high enough to overcome the time premium that you pay and implied volatilities. There's only 2 good things you should do with an option: sell it or don't sell it. So sell it mode.
So this is the not sold to you moment then.
I was about to sell it to you, Don.
All right. Thank you for that, Don. And now switching gears over to the land of S&P 500 volatility, we have one Mark VIX pit reporter, Sebastian from OptionPit.com, joining us here on the old crystal ball. And Mr. Pit Reporter, what are you seeing in the week ahead from a VIX perspective?
It was really interesting. I don't know. I'm sorry that I missed the top of the show. But did you kind of pay attention to what happened in bonds yesterday?
We didn't discuss it. We didn't talk about it on the show, but we did watch it, yes.
It was unbelievable. Bonds and VIX. The market's down about 10 handles. And, bonds and VIX at the end of the day just got smoked. It was shocking the way that things sold off. Then we saw today kind of follow through on that market. Now, the S&Ps would be up huge if Apple wasn't down $12 right now. Interesting that there were 35,000 of the 585 puts bought this morning. Kind of interesting in Apple. What do I think is going on? We're in kind of this little transition period. I think the market's trying to figure out what's going on. If we get through earnings season relatively unscathed, and we get through, and kind of the last 2 Spanish auctions have gone okay. I'll be interested to see what happens with the S&P. We really haven't done much, but we've seen the VIX slowly creep up from that 14 level up to about 17.5. I still think that kind of time spreads are a trade. I love the short time spread right now, and I think that there's some real opportunity here to kind of be long a little bit of realized and short a little bit of implied. Going at Apple, they're just, they're really, really destroying this thing ahead of earnings. Look for it to maybe get, I was kind of bearish until it started trading to 575.
Yeah,
I'm starting to like it. Now I'm starting to like it into earnings. I think there's going to be some real opportunity there to get long.
Just as we're recording, it just hit the 575 handle. So yeah,
I think there's going to be a real good opportunity to buy some call spreads because that skew is still screwed up. And until we see S&Ps really break one way or the other. Here's something I pay attention to. All right, the SPX is now at 1380. We were at 1380 on the 12th. All right, and the VIX is now at 17.5, and on the 12th we were at 17.25. So we were in a weird situation where VIX had been slowly kind of rallying, and we'd seen kind of this break in correlation of the market where it was slowly rallying and VIX was slowly rallying, and I think that usually leads toward a sell-off. And we've seen that kind of take a 180 turn, and we've seen the VIX start to really take some pain, and the market start to, and VIX kind of react to the market. And I'm watching very closely what's happening. If we see the market stay in this range, in that 1380 to 1400, and the VIX gets down to that 16 into the 16s, market's heading higher. If we see a run right back up to 19 again, I'm going to start to get very nervous and probably unwind all my short vol positions.
Yeah, speaking of vol, like I said, as we're talking, I'm just looking here at this at Apple as it vacillates across the board, and you're right, they are. Despite this 2% down move today, they're not really jacking up vol. They're actually hitting the at the money vol.
Yep.
But they're keeping.
There are people selling those out of the money calls.
Exactly.
It's because the out of the money has been so juiced. We're actually one of the interesting things with Apple vol, as you know, all these VIXs, they're Vega weighted. They're essentially Vega weighted. Not an actual. It's not technically Vega weighted, but they're essentially Vega weighted. And the vol of the 575s yesterday was cheaper than the vol of the 590s. So part of what you're seeing is actually Apple moving down the curve. That squaring function that Don likes to mention every once in a while.
So you're saying the vol skew works then. We are traveling the path.
This is actually moving down the curve. It's really interesting.
Yeah, you're right. I'm looking at some of these 650s and some of the skew up in this. It's a very, very interesting skew they have on here in Apple right now.
Yeah, I'm actually going to be live on television during Apple earnings. Should be kind of exciting.
Yeah, it should be fun to watch as they're going to go somewhere on these.
I'm doing option block on Monday, everybody. So you'll get to hear my beautiful voice next week. Don't worry.
Hopefully via microphone as opposed to telephone. But c'est la vie. We'll take what we can get. All right. Thank you for that, Mr. Sebastian. And that is going to do it for the Crystal Ball segment. That's also going to do it for this episode of Volatility Views. And before we go, Don, what is coming up over in the land of Volex.us that might interest and or intrigue our listeners?
Well, I can't say that we've added a great deal. We keep on fine-tuning the website, and we actually are working on a new wrinkle at the moment as we start to look at pricing of merchandise and vol swap pricing. And one of the features of pricing a volatility swap is to take the variance swap as a beginning and then make an adjustment to that's known as a convexity adjustment. In order to do that, it turns out that one of the terms that you need in that adjustment, because vol swaps are usually struck at a lower number than variance swaps, is the actual volatility of volatility, or the variance of a variance, looking forward over the lifetime of the swap. So that would be, if you will, a kind of a future-looking prediction of volatility of volatility. And we make predictions for volatility itself, but not for vol of vol. So we're looking at incorporating that and actually trying to get a handle on how volatile volatility might be going forward, rather than just chronicling it historically. So that's something that we're turning our attention to.
A change of perspective for you boys over at Volex. All right, thank you for that, Don. And Mr. Sebastian, in addition to your upcoming TV appearance where listeners may or may not want to see your face, what else can people look forward to?
I'm going to be on Fox Business after the bell on Tuesday during Apple earnings. And we just got all sorts of stuff going on. We did a free webinar on the weeklies last week. It was a really interesting and good webinar. And one of the things I found, Mark, is I got this asked by more than several people. It was, what's the difference between volume and open interest? Which scared me. And these are people that claim to actually be trading.
Andrew brought this up on one of our other shows.
You don't know the difference. Mark, we have a special landing page for Option Insider clients where they can buy my silver course for $69, which is dirt cheap. And it's the price of an option book. If you don't know the difference between those two, then I demand that you take this course. All right? So does Mark.
Yes.
All right?
We demand it. We had this discussion with Andrew yesterday because he brought up that same topic about how people are so conflated on open interest right now and what that actually means, and how people are saying they shouldn't be trading products regardless of the spread in those products if there's no open interest.
Well, that's the silliest thing ever.
Yeah, it's just people have this cult of open interest has sprung up.
Well, they don't get it.
And maybe we're partly to blame for that because we always talk about open interest. At least I do on the odd block of the option block when we're looking at activity. So it has some bearing there, but I don't ever when I'm trading say, by the way, unless it's an extremely thin issue or something like that. But then you see that reflected in the spreads, and that's really where you want your focus to be, not on the open interest. That's a moot number.
People really need to understand the nuts and bolts of options, and if you don't, then stop trading. Take the silver course and move on. All right. It's good because it's good also because it supports this podcast, and the podcast is free, so it's a good way to support things.
Yes, all the free stuff we put in your earlobes every week. At the very least, you could do is kick back to good old
benefit yourself.
Good old Mark Sebastian, and also pick up a one lot on the NASDAQ vol contracts when they do list, so the boys at Volex know you're listening. All right, thank you for that, Mark, and thanks to all of you out there for listening and downloading and streaming and subscribing to this show and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.